I think one of the most interesting things about your research is that there's so many individuals that follow the value investing framework. And I think everyone's knowledgeable with a canon of material out there, securities analysis, Benjamin Graham, but you've added some new twists to that through quantitative research. And I'm wondering if you could talk about that and how that plays into the concept of the acquirer's fund.
Well, I think rather than adding too much of a new twist, what we've done is just revived some of the old ideas. So because Warren Buffett has been so successful and he's the avatar of value and he preaches this wonderful company at a fair price philosophy, many of today's value investors have similarly embraced that philosophy, and so they look for particular things: high returns on invested capital, moats, compounding type businesses that grow very rapidly, and then they're trying to buy at a fair price, which might be, say, a market multiple for a company that is better than that. That's one very small part of value investing. There's a much broader universe out there. The idea is simply that you're buying something for less than it's worth, and that's hard to do because most companies don't really trade at a big discount to what they're worth. The places where you find those big discounts is in financial distress, where an industry might be going through a down cycle. And so that is what I describe as deep value, where what we're trying to do is we might be trying to buy at a discount to balance sheet value. We might be trying to buy a cyclical company at the bottom of its cycle and then trying to buy at a further discount to that. And then we're hoping that there's an uplift in the way that the business performs, and then you also get the discount between the intrinsic value and the price closing, and so you have two ways to sort of make money. So we did some research. I did some research with Wes Gray, who was a PhD at Booth. We went and found every bit of industry and academic research that we could find that had been published from Graham onwards, so from the 30s onwards, and we tested that in a system to see what works, what continues to work, what stopped working, what never worked. And so there are many things that were perhaps a product of data mining. So we looked at how do you identify a good credit? How do you find something that's financially strong? How do you identify earnings manipulation? How do you find statistical fraud? How do you find businesses that are very cheap and can grow and buy back stock? And the product of that research was a book called Quantitative Value. And I noticed this unusual phenomenon while we were doing it, that very undervalued companies behave in an unusual way, that sometimes the things that the less attractive the business, the better the performance of the stock, because they just get too cheap. And so nobody in their right mind would go and buy these things unless you can find some of these other indicia of value or quality in there. And so that was a book called Deep Value that came out in 2014, discussing the mechanics of mean reversion. And those mechanics are, simply there are private equity funds, there are activists who will come in and turn these companies around. There's also management in there not liking the performance of the company. They might be beholden to the industry cycle, and as other participants in the industry leave, the ones that remain can ask for higher prices for their services or for their goods, and so that they then get a period of very good performance. I just found that a fascinating kind of approach, and it's not one that is discussed much outside of Buffett. Buffett's sort of wonderful company at a fair price. And so my research is sort of focused more on those type of businesses, and that's what the fund does. The fund tries to buy, we like balance sheet strength is great when we can find it. So we love a strong, healthy balance sheet, lots of cash flow coming into the business as well, lots of free cash flow. This is on the long side because we do run long short. We like the company to be buying back stock. I think that's a very powerful signal. It shows that there is that free cash flow there. It's genuine free cash flow. Management's thinking like you would want management to think, taking advantage of that undervalued stock price. And I think that when you see a material buyback, that also indicates that the stock is undervalued, because you see lots of buybacks through the cycle. Buybacks tend to peak at the top of the cycle, but they might be mopping up option issuance or just trying to goose the stock price at the very top of the cycle. That's not the kind of buyback that you want. You want material buybacks. So those things together on the long side, that's a pretty traditional. We're going to find we will own cyclical companies. We'll buy companies that it might be difficult to understand the reasons why we're buying them because it might look like the business isn't a particularly good one. But we think with the combination of balance sheet strength and at the bottom of the cycle, it'll look like a healthier business going forward. On the short side, we're looking for somewhat of the reverse of that, something that's extremely overvalued to the extent that you can identify a value, because some of these companies, it's very hard. There may not be any value there at all. But they have, more importantly, they're in financial distress. There's some statistical earnings manipulation or statistical fraud. They have negative free cash flows. So the way that they're financing the business is by raising equity or selling debt. And that's a game that can go on until it sort of stops, until the market no longer lets you do that. And so we also look for broken momentum, because many of these companies will finance themselves by telling a great story, even though the financial statements don't reflect the narrative. The narrative is wildly diverged from the financial reality of the company. So that's what we like to find on the short side. Really compelling narrative, but none of that is being reflected in the financial statements. And so when the market starts seeing that too, and that momentum has gone or the momentum is broken, we'll take a short position. In the ordinary course, we hope to make a little bit of money on the short side, but the real function of the shorts are when the market collapses, they should provide more protection than their weight in the portfolio. And so you would hope through a 2000 or 2007 and 9 type scenario that it would perhaps prevent you from drawing down as much as the market.